Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the USA with Glen Sutherland. This week, my guest is Kris McEvoy, repeat guest and regular guest Kris McEvoy. Kris, you want to start off by giving everybody a quick introduction to yourself?
Yeah, so I'm a cross-border accountant. My office is in Fonthill, Ontario. We service clients virtually all over North America and indeed all over the world. And our specialty is Canada, U.S. For obvious reasons. And a subset of that is Canadians investing in the USA.
Anyway, Kris, that was great. What I wanted you to come on and talk about today was we did a podcast, I don't know, about 6 months ago about Trump's big, beautiful bill. And at the time, it wasn't through legislation. They were still working on it. But now it's through. And so I thought we should do a follow-up episode just to talk about, what's happened and how this affects Canadians that are investing in the U.S.
Yeah, so I'll start off by saying that the one big, beautiful bill did pass. However, the part that was really troubling for non-U.S. people like Canadians in the bill was originally Section 899. And that had all the proposals in it about things like increasing withholding taxes, which would have affected things like FIRPTA withholdings and so on. That piece didn't make it into the final legislation. Additionally, Canada repealed its digital services tax. So, arguably, as a matter of politics, that was what the current U.S. administration's aim was, and they got the result they were looking for. So we can say that that was effective. But ultimately, the Section 899 is never seen the light of day, which basically means the tax treaty that Canada and the USA has always had, or for really years and years and years now, stays in force and has not been modified in any significant way. Okay. So in terms of Canadians specifically, there really doesn't end up being any real change, any real impact, because the Section 899 got left out of the final bill. There are some goodies in there for real estate in general. For instance, for those who are familiar with cost segregation studies and bonus depreciation, there was a fair bit of things in there about enhancing that and increasing that. So if you're unfamiliar with cost segregation studies, you may want to look at that, because effectively, if you get a study done on your property, which kind of breaks it down between the property versus appliances and flooring, other things like that, versus improvements and so on, you can become eligible for much larger write-offs. So this will help Canadians who have a goal of having U.S. Taxable income as close to zero as possible, because as far as strategy goes, in the U.S., it's a little easier to implement a strategy that basically says, as long as I keep buying things, I can keep avoiding taxes, right? So as long as you keep buying, good reason to keep buying properties, right, is that, you can keep using these sort of enhanced depreciation rates, which are much higher than what Canadian property offers. So depending on how you're structured and whether or not you've done your cost segregation studies, you can take advantage of some of these enhanced depreciation, which helps you avoid U.S. tax. And it also helps you avoid Canada's FAPI tax, because a big part of planning now is avoiding the foreign accrual property income tax, and keeping your U.S. taxable income low is kind of the name of the game when it comes to avoiding that FAPI.
So you just mentioned like cost segregation. Is that something that would be a problem for Canada Revenue if a Canadian is doing cost segregation in the United States? Are you interested in investing in the U.S.? I honestly see Canadians making tons of mistakes, simple mistakes that could be avoided by just a quick phone call. Honestly, I think we should just get on a 15-minute call. You ask me some questions, I answer some questions, and I tell you a little bit about the coaching program. We see if it's a fit. My coaching program is completely different than other people's. What my goal is to help you actually implement
the material. All the videos are pre-recorded, so you can just zip through those on your own time. But when you're actually buying property, this is what sets me apart, is that we actually sit down, you do your deal analysis, you have questions, ask me some questions. Let me go through it with you. Let me help you. And this is what's going to set it apart. This is why you're going to avoid mistakes. You're going to miss those little things that you just missed that could cost you a lot of money. Maybe I can see it. Maybe my experience. I've been doing this for a while down in the U.S. Let me help you. Let's do a quick 15-minute call. If that's of interest to you, go to glensutherland.com and you can book a 15-minute call. Anyway, hope this is helpful. Thanks, everyone.
This depends on how you're structured. So it depends also on, if you own a very small piece of a deal, it likely wouldn't come up. If you are pretty much self-managing, so let's say you have an LP in the U.S., which you own 100% of, or maybe 100% of it between you and your spouse, then that's what's called a controlled foreign affiliate. And then if you're going straight into an LP as opposed to using, let's say, a U.S. blocker co, the rules are different. So under the blocker co angle, maximizing depreciation and cost seg studies and stuff are great. If you're only having an LP, which basically means the income all ends up back on your personal return, CRA expects you to do a certain amount of recalculating of things like your tax depreciation and other write-offs. Essentially, they want you to sort of convert and follow the Canadian tax code, which is somewhat less generous. So yet another good reason to make sure you've got the right structure if you want to get into some of those more advanced things.
Yeah. And also, if you're going to go into cost segregation, you got to be doing a big enough property for it to make sense. Like typically you don't do that on a single family house. It's going to be an apartment building, correct?
Yes, also true.
Yeah. All right. So we talked about that there wasn't really any new deficiencies. That was like one of the add-ons that it could be a positive to have cost segregation. Is there any other positives for real estate in that big, beautiful bill?
When investing in the U.S., Canadians make so many small mistakes. They assume everything's the same. They don't understand all the intricacies. If you just would like a free guide on some of the common mistakes that I see Canadians making, just go to Canadianinvestingintheusa.com/mistakes and check out my free guide. And while you're there, if you want to book a phone call, I'm open. Me personally, not some other person. I'm personally open to doing a 15-minute phone call with anyone, answering some questions, sharing some experiences. So if that's of interest to you, please go ahead and do so.
This bill for real estate is a little bit more about what didn't get killed than any new goodies. For instance, the 1031 also survived, the 1031 exchange.
Yep.
So Canadians would have limited ability to use that. Interestingly, the IRS is not the one that has an issue with foreigners using this. This is a Canada Revenue Agency issue. So, which again largely boils back to that foreign accrual property income I was referring to, which is passive income types are rent and capital gains. So if you have a capital gain, the CRA attempts to kind of shoot through whatever structure you've put in place and put extra tax on that capital gain. And so the IRS would be happy enough for you to defer it, but CRA won't necessarily respect that deferral. Doing a 1031 exchange, especially if you factor in the FAPI in Canada, is sort of the worst case scenario where you're paying twice. You're paying CRA now and the IRS later.
Yeah, makes a lot of sense. Was there anything else I should have asked you about the big, beautiful bill and how it affects Canadians?
No, the short answer takeaway is there was quite a bit in there that could have, but none of that ended up seeing the light of day. So at least for now, until we get further down the road with budgets and stuff, everything's going to remain intact here, at least for a while. Other than to say, you should be having regular discussions with your accountant about any possible changes. It's really not possible anymore to kind of set it and forget it, whether it's structure or your common practices. Tax is a very active area nowadays, especially with the cross-border, given the relationship between Canada and the U.S. Tariffs continue to be an ongoing source of concern for Canadian businesses back and forth. So in some senses, you never know what's going to happen next. So you have to really be paying attention. That's probably the biggest piece of advice I can give.
Love it. And Kris, people are like, hey, I like what Kris is saying. I might be interested in one of his services, some accounting, some bookkeeping, or any of the other things lots of things you do there. But if someone wanted to get in contact with you, how do they do so?
The easiest way is to go to our website, www.leapact.ca. So that's LEAPACT.ca. Fill out our web contact form and I'll get in touch with you.
Awesome. Like always, Kris, I really appreciate you coming on the show. Always tons of value.
Always a pleasure, Glenn. Thank you.
That was a nice video. Bye.